Let's zoom in on how cryptocurrency shows up on IRS Form 8949, because this is where a lot of people get confused and where mistakes are most likely to happen. First, the big idea. The IRS treats cryptocurrency as property, not as cash. That single rule is why Form 8949 matters so much for crypto users. Every time you dispose of crypto, the IRS wants to know about it. A disposal doesn't just mean selling crypto for dollars. Selling Bitcoin for cash is a disposal, but so is trading Bitcoin for Ethereum. Using crypto to buy goods or services is also a disposal. Even swapping one token for another on an exchange can trigger a taxable event. If crypto moved out of your ownership in 2025, it likely belongs on Form 8949. Form 8949 exists because crypto reporting is rarely clean. Some exchanges report transactions to the IRS, others don't. Some report proceeds but not cost basis. Some don't report anything at all. This form is how you explain what really happened. The first major split on Form 8949 is between short-term and long-term crypto transactions. If you held the crypto for 1 year or less before disposing of it, it's considered short-term. Short-term crypto gains are generally taxed at ordinary income tax rates. If you held the crypto for more than 1 year, it's long-term. Long-term gains usually receive more favorable tax treatment. This is why tracking acquisition dates is critical for crypto users. Every crypto transaction listed on Form 8949 usually goes on its own line. Even if you traded the same token dozens of times, each taxable disposal is treated as a separate event. The first column is the description of the property. For crypto, this is typically simple. It might say Bitcoin, Ethereum, or the name of a specific token. Some people also include the quantity, especially if there were multiple partial disposals. Next are the dates. One date shows when you acquired the crypto. The other date shows when you disposed of it. These dates determine whether the transaction is short-term or long-term, so guessing here can cause real tax problems. Then comes the proceeds column. This is the fair market value of what you received at the time of the transaction. If you sold crypto for cash, this is the dollar amount you received. If you traded one crypto for another, the proceeds are the dollar value of the crypto you received at that moment. This is one of the biggest surprises for crypto users. Even if no cash changed hands, the IRS still treats the transaction as if it did. Next is the cost or other basis. This is what you originally paid for the crypto, including certain fees. If you bought crypto in multiple batches at different prices, tracking basis can get complicated quickly. If you received crypto as a gift, the basis often carries over from the giver. If you inherited crypto, the basis is usually stepped up to fair market value at the date of death. These situations almost always require Form 8949. Now we reach the adjustment columns, which are especially common with crypto. Adjustments may be needed if an exchange reported incorrect information, if fees weren't included, or if part of a loss is disallowed. Each adjustment uses an IRS code instead of a written explanation. Wash sale rules are a gray area for crypto. Traditionally, wash sale rules apply to securities, and crypto is not classified as a security. However, tax professionals often take a cautious approach, especially as regulations evolve. If wash sale treatment is applied, Form 8949 is where the adjustment would be recorded. After adjustments, the final column shows the gain or loss for that crypto transaction. A gain means the value at disposal was higher than your basis. A loss means it was lower. Once every crypto transaction is listed, the totals are carried over to Schedule D. Form 8949 doesn't calculate your tax. It documents the transactions so Schedule D can do the math. If your crypto gains exceed your crypto losses, the difference may be taxable. If your losses exceed your gains, some of those losses may offset other income, with any remaining losses carried forward to future years. Many crypto users ask whether Form 8949 is required if their exchange already sent a tax form. The answer depends on the details. If the exchange reported proceeds but not basis, or if any adjustments are needed, Form 8949 is usually required. Even when it's not strictly required, many taxpayers still use Form 8949 because it creates a clear audit trail. Crypto transactions often span multiple wallets, exchanges, and platforms. This form pulls everything into one place. Another important point is consistency. The IRS often matches reported proceeds against tax returns. If exchanges report activity and your return doesn't reflect it, that mismatch can trigger IRS notices. Form 8949 helps explain those numbers before questions arise. By the time you finish Form 8949 for crypto, every disposal has been documented, dated, valued, and categorized correctly. When the totals move to Schedule D, the most complex part of crypto tax reporting is already done. In simple terms, Form 8949 is where your crypto activity gets translated into the language of the IRS. It turns trades, swaps, and payments into a clear record of gains and losses for the 2025 tax year. If you use crypto, this form isn't optional paperwork. It's the bridge between the digital asset world and the traditional tax system. Done carefully, it protects you, supports your tax return, and makes sure your crypto activity is reported the way the IRS expects. Before wrapping up, there's one important reminder worth slowing down for. Cryptocurrency taxes are still evolving. The rules are newer, the guidance changes, and the details matter more than most people expect. Form 8949 may look straightforward on the surface, but crypto adds layers of complexity. Multiple wallets, multiple exchanges, different acquisition dates, different cost bases, different interpretations. One small mistake can change a gain into a loss, or turn a simple return into an IRS question. That's why seeking professional tax advice is often a smart move when crypto is involved. A qualified tax professional understands how Form 8949 applies to digital assets. They stay current with IRS guidance, and they know how to handle gray areas correctly. This doesn't mean you've done something wrong. It means crypto is new, it's nuanced, and it doesn't always fit neatly into traditional tax rules. Accurate reporting protects you, it reduces stress, and it helps ensure your crypto activity is reported the way the IRS expects. When it comes to Form 8949 in crypto, every transaction tells part of the story. Every date matters. Every number matters. And sometimes the best decision is to have an expert help tell that story the right way.